So those are kind of the big picture principles, and now we'll start talking a little bit about the fake news. I came to New York and walked by the Trump Tower, so I figured we'd have to throw this in here. So let's talk about maritime shipping. Trade war. Terrible time to be involved, right? Why do we like it? First of all, it's a niche sector. Most people don't know a whole lot about it. Most people think shipping is totally US-China. It's retail goods. The trade war is going to completely shut down shipping. There's not a lot of publicly available research. And that plays to our advantage, right? Because we publish research on Seeking Alpha. We offer our own research platform. And for traders out there, this is a wildly cyclical, heavily levered industry. So whenever there's a little bit of move in rates, 20, 30% move in rates, these stocks can double or fall down 50%. Right? Dry ships was a painful example, but there's a lot of other ones that have been a little bit more up and down. The best part about this is that almost every single news report misses the mark. Monday through Wednesday, I was at a thing called Marine Money. It's the biggest shipping investor and finance conference in the world. It was here in New York City. I had meetings with 27 companies and 15 investors, including hedge funds and family offices. And we had about 900, 950 delegates at this conference. And there's some reporters at the conference. And I'll tell you, the dumbest questions that I got at the conference about investing and about shipping were from those reporters. And they're the ones out there making the headlines. And they're the ones moving these stocks a lot of times. So in conclusion on that, there you go, there's our meme. All right, guys, so let's talk 3 quick misconceptions about shipping and why we like it. So misconception number 1, and a gentleman ahead of me just kind of talked about the trade war, is that trade war is killing shipping. Shipping is getting crushed. And if you look at the stocks, some of them are. In fact, the majority are down 40 to 70% from last year. The stocks are getting crushed. Sentiment is terrible. However, if you think about shipping, there's actually about 7 different subsegments. You have dry bulk, the iron, the coal, you have the crude oil, the gas, LNG exports are a big thing. Trailing 12-month profits in every single segment of shipping, every single one, even container ships, which are the riskiest ones, are higher than the previous year. The valuations for these stocks, price to EBITDA, price to earnings, price to forward earnings, price to NAV, you pick any single multiple you want, they're near all-time record lows. 30, 40-year all-time record lows. So the reality is that the US-China trade, or US-China trade in particular, is a very small part of the trade. In dry bulk, it's about 2% of the market. Crude oil is emerging, but it's still 2 or 3% of the market. Containers are the only industry where there's a significant portion of that trade between US and China. Containers, retail goods, Target, Walmart, Amazon, that kind of stuff. Second misconception. Low oil prices right now are hurting tanker companies. In reality, the cost to transport oil across the world is a tiny percent. One single cargo in an oil tanker pays for that entire tanker. Just 2 or 3 month trip and you've already paid for the whole tanker. Stocks, the oil tanker stocks, they correlate very highly with oil. So if you're just a day trader, you've probably made a lot of money doing the kind of correlation stuff between tankers and oil, and good for you. I mean, if it's working for you, keep doing it. Don't change your strategy. However, if you're investing in these companies and you care about the earnings and you care about the dividends down the line, understand there's basically zero long-term correlation between oil prices and tanker stocks. If we want to get a little theoretical, if anything, low oil prices are better. Low oil prices are going to drive higher demand in Asian countries and European countries, which is going to drive more demand for the tankers. The biggest thing is volatility as well. So when you see these big up and down days, like today with the Gulf stuff with Iran, that's actually very good for tankers. Let's talk about a third one. The product demand, like the Asian growth of consumption, is the same as shipping demand. That's not actually true. It's ton miles. It's how far these tankers are traveling. You guys know what the biggest growth in exports in oil is? What country is the biggest growing exporter? We are. The US Gulf to Asia is over twice the distance of Iran or the main Gulf to Asia. The US is taking over OPEC's share, and so for every 1 to 2% growth in Asia, the shipping demand goes 4 to 5% up. In shipping, a 2 to 3% change in demand can double or triple these stocks. So we get tied up on these trade war and we look at these stock prices, we're missing the fundamentals. It's a quick slide here for you, a little technical, but in the circle in red it shows Middle East, a cargo would take 28 ships to do that regular trade per year. If you pull the oil instead from West African projects or from the US Gulf, it takes 57 vessels. So you can see right there we're basically doubling the cargoes. 81% of global oil production growth is west of the Suez-Max Canal, over here by us, either Africa, Brazil, or America. Meanwhile, 81% of the forward demand, refineries and consumption, is in Asia, the longest trade route in the world. So we flagged this early, and this is an example of one of the research reports we put out on Seeking Alpha. You can see I'm taking a victory lap here. I've made some bad calls too, as you see by the black eye here, but January 11th, right, DHT Holdings, biggest pure play VLCC tanker stock. It set the soar. There we go. If you understand the fundamentals, you understand the market, you don't get tied into fake news cycle or asking these dumb questions and falling into these bad patterns, you can do very well in the shipping sector. I'll ask you one more stock you can look at, LPG, Dorian LPG. Pull that up, look at a 3 to 6 month chart, and you'll see what you can do when you get in front of a massive cycle. Day rates are $65,000 a day. Last year they were only $10,000 a day. Thank you very much for your time, everyone. I'll be in the back and ready to answer questions.